Hey guys, John here with a silver update. I'll just update that a bit. Hey guys, go on. Firstly, I just want to show Guild F40 this. Check it out, buddy. Love it. Friends of mine from the UK just recently came back and got me this as a gift. For those who don't know Guild F40, that's his avatar here on YouTube. Keep calm and carry on. Nothing to see here. Very cool. Leverage. Now this video is about leverage. Where is leverage in the market? What is leverage and how leverage can possibly affect these markets? Now firstly, for the uninitiated, leverage is basically controlling more than your equity would otherwise allow you to control. For example, if you have $100, if you invest that into a stock with no leverage, the stock has to double for you to make $100 profit. And obviously the other way, the stock has to go to zero for you to lose that entire $100. Now, say 2-to-1 leverage, if you want to leverage up that trade, 2-to-1 leverage, the stock only has to rise 50% for you to make $100. And negatively, the stock has to only drop 50% for you to lose $100. So that's basically how leverage works. It magnifies the gains and the losses, and so basically you can get as leveraged as you really want. I mean, obviously there's a limit, but in the GFC, during the GFC, there was, reportedly these banks were leveraged hundreds, even multiple hundreds of times. So it really does magnify the losses. Now you can imagine if, say, for example, in an equity in a company, all the traders in there are highly leveraged. If the stock suffers a little bit of a pullback, it will entice a lot more sellers to come in because they can't afford to wait for it to drop, say, 50%, because there might be leverage 10, 20, 30 to 1. If the stock drops 10%, they're out. So that means they have to sell, and they're selling 10 times more than they otherwise would because they're leveraged, say, 10 to 1. So leverage exacerbates price movements. It exacerbates it on the way up because there's, many more times of worth of money coming into a commodity or an equity, and so it exacerbates price movements up. So that's why you can see silver go from $18 to $42 in the space of months, and so it really magnifies that move. And conversely, you can also do it on the downside as well, as those trades unwind, or what we call deleverage. Now, during the GFC, all the leverage in the system was in the housing market and related instruments, CDO, CDSs, all those acronyms that we've heard of before. That's where the leverage was at. And so when they unwound and created this domino effect within the banking system, that's basically the GFC in a nutshell. That's why everything collapsed the way it did. And then you had all these contagion effects of people having to unwind their position and banks having to unwind their positions. So what Bernanke did was he basically shifted the leverage from out of the housing market into now, well, things like the commodity complex, basically assets, equities, commodities, and that is now where the leverage is at in the system. So even though you could be invested in something as secure and safe and, as gold, there still can be a lot of leverage in the system, and that leverage can be considered risky by, say, the hedge fund that is leveraged in the gold trade. If a hedge fund is leveraged 100 to 1 or more in gold, then if gold shows signs of weakness or starts to dip, that really magnifies a hedge fund's profit or loss. So they have to unwind that position, or they may choose to unwind that position, which is really 100 times more in terms of value, market value, than what they really were putting on the line, what they were originally controlling with their principal. So that will bring the gold price down a bit, and then because other people are leveraged in the market, it creates this domino effect. So that's why we saw during the Japan earthquake, gold and silver got smashed. In fact, everything got smashed because even though it was bullish news for things like gold and possibly even silver, but certainly gold, the hedge funds unwound their risk, what they would consider a risky trade. Even though it's gold, it's still considered a risky trade because of the amount of leverage. So leverage in itself is risk. or speculation. Doesn't matter what you put it in, you're speculating. Now, that's why we saw gold and silver get heavily hit. Now, it recovered pretty quickly, but that shows you a glimpse of what can happen in over-leveraged markets. And that is what Bernanke has done now. By his monetary policy, he's basically shifted the speculation from the housing instruments into the commodity complex, into the equity markets. That's what he's done. So you need to understand that moving forward. You need to understand that's why silver can do what it does from 18 to 41. But on the downside, it can also do it as these speculative positions are unwound. Now, they're not speculative in the sense of all gold, such a speculative investment, but speculative in the amount of leverage that's behind them. That makes them a risky trade. So, for example, silver, I think it's good to see a bit of a correction because it was getting parabolic there for a second. I think it can come down to 36.25, so another $4 off the price. There's a few reasons why I think that. Doesn't really matter. It's really just a guess, educated guess. But as I said, no one really knows the amount of leverage in a system, and so no one can really anticipate the effects of leverage unwinding or being built up as well. So no one would have guessed that silver would go from 18 to 42 in 8 months. Not even the biggest bull. I mean, I came out in 2011 and said I would like to see silver between $40 and $50 this year. I never expected it to make a beeline in the first 4 months from, 20 to, it's basically doubled. It's just crazy. But that's what leverage can do. But it also can do it on the downside as well. Now, the point I'm trying to get to is I see basically at the end of this QE period, June, July, Ben Bernanke, I've said it on my, I think 2 videos ago, he will not come out and say that he's doing QE3. I'm willing to bet a lot of money on that he won't say, okay, now we're going to roll over and do QE3. He will not do it. I sort of mentioned Jim Rickard's interview where they will still continue to do QE behind the scenes, but they won't do it to the effect of as blatantly public as they were. It'll be from the maturing funds in the current 600 billion that mature, they'll be able to sustain themselves for a little bit longer. They will not come out and say QE3 straight after QE2. It won't happen, guarantee you. And so what could happen at that time is a massive deleveraging in the system as I guess the people on one side of the ship move to the other side of the ship. Everyone betting that QE3 will happen, or at least riding the QE2 wave, not even considering what will happen with QE3, but just enjoying QE2 while it lasts, as those traders unwind and those hedge funds unwind, and then the realization that there may not be an official QE3, that will move the leverage out of the commodity complex and out of the equity complex as well. And so I believe that is probably when the correction will occur, significant correction in everything, if not sooner, because generally if the market can see something happening by a certain time, if everyone can see that happening, then it happens instantly. That's the idea of an efficient market. I mean, we can speculate on what we see happening, but it's only when the market agrees with my speculation that it'll happen sooner, if that makes sense. So that's what I can see happening. Now, I think short-term silver can come down to $36, I think, like I said, 36.25, where there's a gap on a chart, and silver loves to fill it. From there, I'm not sure. We just have to see how it plays out. But over the next few weeks and months, I think we'll start to see the realization, or basically the speculation, that QE3 won't happen, QE2 is ending, and that leverage will need to come out of the system, which is a good thing because it prevents bubbles from forming, it prevents things from getting overheated, and so it may mean that gold and silver take a breather and allow for more buying opportunities, because at the end of the day, towards the latter half of the year, I see another big upswing in commodities and silver and gold, when the real not the speculative positions come in, but the real general people positions, just the force of the public comes in and overwhelms these markets. I still think we're too early for that. It just hasn't hit people the way it has. Silver has been a trade, a mainstream trade. People will leave it just as quickly as they got into it. I think it's not something that will, people are passionate about like probably most people on this channel are. So it's probably a good thing. It gives us a buying opportunity. If I have one piece of advice, don't jump in and buy on every dip from here. Understand that leverage works in a very trend-following manner, like a domino effect. It works big on the way up and it works big on the way down. I don't know where silver can go to in this sort of leg down. I believe the top is in for a while, but I think possibly 36 would be a place on the chart that I'd like to see get filled anyhow, at least from a technical point of view, because there is a gap on the chart there that silver likes to fill. So yeah, just understand leverage, understand the power of leverage, and that it is in these markets. It is in these gold and silver markets. It is in every market at the moment, in the commodities complex. Oil is another thing to watch as well. Obviously, if oil keeps moving up, that'll also have a natural effect on silver going upwards, but also if it does get hit moving down, silver and gold will come down with it. So watch oil at the moment as well. You might get your leads from oil. Actually might be somewhat of a leading indicator. Okay guys, that's it from me. Talk to you soon. And this week we launched SpotMex. Talk to you soon.